Hello all, welcome. In this video, we'll be looking to answer some questions that have arisen due to the changes or amendments made in the Finance Bill 2023. Now, as a financial planner, I come across a lot of my clients or prospective clients who have a lot of questions regarding the new changes that have been made to debt mutual funds and what might their impact be on investments. Today, I have Samyukta with me from the investment strategy team and a principal fixed income specialist who will be answering all these questions. Now, to start off, let me introduce Samyukta. Hello Samyukta.
Hi Nakul.
With the introduction of the Finance Bill 2023, some of the questions that people might have, and one of the most common ones is, going forward, should they be stopping their SIP investments in debt mutual funds from April 2023?
I think that's a very valid question to be asking at this point, because obviously many people took advantage of the tax differential treatment between, say, a recurring deposit and a fixed deposit. Now today, with that going away, it's natural to wonder whether it's still a good option to have. I think it boils down to really two questions and how the investor is going to be able to answer them. The first is, why are you doing the SIP in the first place? What is the goal that it is tied to? When is that goal expected to happen? The second question is, can you actually tolerate some variability in returns? Now imagine every year I am saving for my son or daughter's school fees through an SIP. Now I don't really want to see variation in that return, right? So if my current RD rate is coming at a very similar rate or even higher than that, I would prefer to do a recurring deposit rather than focusing on having an SIP that's running through this. Alternatively, if I have a long-term goal like retirement, where I'm in my 40s and I'm expecting to retire in the next 15 or 20 years, then it definitely makes sense for me to continue my SIPs in debt funds, simply because my investments can compound without paying tax for the next 15 or 20 years. Then at that point, whether it's the same tax slab or not, I still get a benefit by allowing this compounding to happen.
Now, coming to the question of a FD or a fixed deposit, should someone be looking at maybe taking some money out of their FD and putting it in a short-term debt instrument to take advantage of the tax benefit?
I think one thing is, we are in this sort of once in a lifetime opportunity window, right? We have the rest of this week or until the end of the month to make a decision on how to take advantage of this small window of opportunity that we have. Now, if I look at a bank FD, I'm not really taking any risk with that product. I earn, say, 7% on a pre-tax basis. Now, similarly, if I look at a high quality debt fund, I'm getting the same 7% yield for a 3 to 4 year horizon, somewhere between 7 to maybe 7.25 or 7.35. Now, given this is where the yields are, and the predictability of what could happen over the next 3 years, and if I assume inflation to be somewhere between 5 and 6%, my post-tax return on the debt mutual fund investment that I make today will come somewhere between 6.5 to 7%. And that's a fantastic post-tax return. Now, if I wanted to do the same thing with an FD, I would have to do an FD that's giving me somewhere between 9 to 10% if I'm paying 30% tax. Now, to me, that smells like an opportunity and something that people should take advantage of now. Because if you're an FD investor, you can always build another FD in the next couple of years or however you've done it in the past. But to get the same opportunity in debt funds, I don't know if you'll get it again.
Now, as you said, this is a lifetime opportunity, once in a lifetime opportunity, right? Yeah. So, should someone be look at restructuring their portfolio? Meaning, let's say for example, someone who already has like short-term mutual fund units that are less than 3 years old, should they be looking at maybe redeeming some of this and maybe putting it in another instrument in the interest of restructuring their portfolio?
Yes, I think this is not something that you can advise like at a broad level. There is merit in sort of reviewing your portfolio and understanding what is working for you, whether this is the investments that you have are buy and hold for as long as you would like, right? In certain cases, they may not be. Some funds do well in certain parts of the cycle and don't do so well in other parts of the cycle. That is not necessarily a buy and hold forever or buy and forget kind of investment, right? You need to tactically enter and exit those kind of funds. Whereas if you're in a fund that is more all weather and works across every cycle, then I think there is merit in moving, even if you have short-term units and you're going to pay your full marginal tax rate, move some of those into more tactical long-term and buy and hold investments. If you have long-term units also, you can consider this, because unless it's something that you can keep and you'll sleep well at night, it makes sense to restructure the portfolio.
Now, of course, coming to the question of NRIs, let's say someone in the US or Europe who's coming to India to retire. How can debt mutual funds specifically help them for this goal of retirement?
I think if you're an NRI and you're fairly confident that you're going to be coming back to India to retire, then it definitely makes sense to have some debt investments in India. And again, like if you're young and in your 40s, then definitely, if you like, imagine getting 20 years of indexation at the time of retirement, right? That's an amazing sort of tax benefit that you could get, and you have the small window to do it. So NREFDs are of course like a fantastic investment option, and you should continue those investments beyond April 1st. But your ability to allocate into mutual funds is just a very short window. You can continue to do it after April 1st, but the taxation differential will still be there.
Now, like any product, in debt mutual funds also, two products take center stage: the open-ended funds and the target maturity funds. What is your opinion on it, and what should investors expect from these funds?
To be honest, I think both are exceptional products and they work for different reasons. So let's start with target maturity funds. When it comes to a target maturity fund, you would have noticed that all of them invest in the safest of investments, which is your central government bonds and your state development loans. Now, they're also low cost products because they follow an index, so your portfolio is pretty stable. And in this case, I think these are winning points for a target maturity fund. The only drawback that I would see is that since there's a maturity date, there's a sort of forced exit in this investment, right? So what I mean by that is the fund decides when I should exit, rather than me choosing that, you know, today I want this money out. So I think that's the only sort of drawback that you have in target maturity, but it works. Let's say I have a goal in 2028, right, and I have a 2028 target maturity fund, then it works for me, because anyway I would have to exit at that point. So I think that's something to keep in mind. But when it comes to open-ended funds, you do have these all-weather mutual funds which you can buy and hold and stay invested for any number of years, whether it's 3 years, 5 years, 7 years, 10 years, whatever your horizon is. You can be invested in these schemes and you can decide when you want to enter and exit. Now, here the only sort of risk that I would foresee is that there's a lot of fund manager discretion, right? So if you get into a product where there can be many calls with respect to, say, the duration of the portfolio, or the credit quality of the portfolio can change a lot, then that is something you may not be very comfortable in, because let's say I buy a particular fund today and it looks like a completely different fund like 5 years down the line. I may not be very happy with that as an investor, right? So I think that's something to keep in mind and to be careful about when you're making a longer term choice.
That is very well put, Sam. Now, coming to the question of AIFs or alternative investment fund. How do they compare against debt mutual fund, and what should an investor investing in these funds expect from them?
Okay, I think this has come up a lot for debate in the last few days, primarily because high net worth investors are now looking at AIFs as an alternate to mutual funds. And I think it's a little bit unfair to score both of them or compare them as an apples to apples comparison, because it doesn't work that way. Now, I think there are certain advantages to being in an AIF, which is that you don't have like an asset liability mismatch, or you don't have this pressure of funding redemptions as and when they happen, right? But at the same time, these are higher risk investments, because you are looking at performing credit, or you're looking at bonds which are not listed, or companies that are not listed who are issuing bonds, and there is a much higher level of credit risk that you are getting into in this product. Whereas if I was looking at a target maturity fund where I'm getting, you know, only government securities, the credit shift is huge. And so for a conservative investor, you need to think about whether you have the risk appetite to move into a product like an AIF. And you can't look at only post-tax returns. Like, looking at post-tax returns is a great metric, but you need to look at other things as well, right? So what is the quality of the portfolio? How is the fund manager, like what is their style of investment? What covenants do you have which are going to protect you in case things don't go your way, right? Which point of the market cycle are you in? These are all, and most importantly, like what are the expenses associated with this particular investment, right? So on mutual fund schemes, you have a cap on what it can be. When it comes to AIFs, it's not so tightly regulated, and you can have layers of fees, right? You might have like a fund management fee, then you might have a performance related fee. And these target like much higher IRRs on the portfolio. So I think keeping all of this in mind, there's no rush to make an investment into an AIF today. Like the time sensitivity and the urgency applies to mutual funds, because after April 1st, you're not going to get the indexation benefit. That doesn't make them a bad investment option. At the same time, I think there is a space for AIFs, and there are a certain category of investors for whom it could be suitable. And but take your time to understand whether that category of investor is actually you. Don't feel rushed or pressured into making this decision, because there isn't actually any urgency to do this. So take your time.
Thank you for your very clear input, Sam. Hope you guys got more information on what it means to be a debt mutual fund investor going forward, and the different types of products that are available in the market. If you guys have any more questions, do drop them in the comments. We'll be happy to answer them. Thank you.